Hi, everybody. My name is Brian Koscak, and I am a Vice Chair of the Private Capital Markets Association of Canada and a lawyer.
I'm Nadine Milne, also a Vice Chair of PCMA Canada and a Chief Compliance Officer.
So you have a lawyer and a CCO, and we're talking about investor types explained. Nadine, what's the backstory about why we're talking about this important topic?
In the private capital markets, you have to invest via a prospectus exemption. And these prospectus exemptions have various definitions that go with them. There's the accredited investor, permitted clients, and eligible investors. We're going to take this opportunity to talk about the different definitions and some common questions and concerns that we have with them.
Good point. People are often confused as what's an eligible investor, an accredited, a permitted client? And so we're going to do a deep dive into these very concepts to hopefully simplify them and help you in your practice. Now, before we get going, this presentation is for educational and training purposes only and does not constitute legal advice. If you require legal advice, consult a lawyer. Now, Nadine, set out the agenda for what we're going to learn today.
We've already talked a bit about the purpose of the presentation. We're going to talk about the source of the laws that we're looking at. We're going to discuss accredited investor definitions. Then we'll talk about permitted client definitions and implications. Then we're going to talk about eligible investors versus non-eligible investor definitions, and then finish up with some key takeaways.
Fantastic. So we have lots ahead of us. Let's jump right into it. Now, the purpose is to talk about these different terms. And let's get into the first one, which is, what do you mean that these are commonly misunderstood terms, Nadine?
The private capital markets can be complicated, and there's different definitions that are used at different times. So it's important to try and understand which definition is applicable when, and what are the benefits of using the different prospectus exemptions based on availability, because they do have different investor protections available.
Exactly. Now, these terms apply to different prospectus exemptions. The eligible investor definition relates to the offering memorandum exemption, which is set out in Section 2.9 of 45106, which is called Prospectus Exemptions. And those involving accredited investors are under Section 2.3 of 45106, involving the accredited investor exemption. So that's where you're going to find them. Now, speak a bit about how these terms have different investor protections behind them, Nadine.
So the different definitions do have different bright line tests in terms of sophistication and asset levels. And the lower the levels, the more protection the regulators have. So when you're talking about an eligible investor, they're generally a retail investor or maybe a little bit higher in level. So the regulators want to have additional protective controls in place for those investors. When you come to accredited investors, the idea is you have a little bit more financial sophistication, as well as the ability to tolerate more risk from a financial perspective. Therefore, there are less protective measures in place, with permitted clients being the most financially sophisticated, or the ability to hire those with the financial sophistication to be able to provide them protection. So the regulators aren't looking to protect those types of investors as much as they are, for example, your eligible investors.
Well put. So this is not one size fits all. These are three different types of investors. And if you look at them at a continuum, eligible investors have the most protections afforded under securities legislation in Canada, then accredited investors, and then permitted clients, which are generally seen to be able to fend for themselves. Okay, now, where does one find the source of these definitions and exemptions, Nadine?
There's a couple places. You can find them in National Instrument 45106. So this is where you can actually look up the details of the various prospectus exemptions. So as we discussed, 2.3 for the accredited investor exemption and 2.9, the offering memorandum exemption. Within 45106, there is a definition of an accredited investor as well as an eligible investor. You can also look to the Ontario Securities Act, which is where they've used some of these definitions directly in the Ontario Securities Act itself, but they are the same as those found in 45106. For the definition of a permitted client, you have to go to National Instrument 31103, which is registration requirements, exemptions, and ongoing registrant obligations, because that's where you find the permitted client definition.
And for those into the policy side, you're going to ask, why is Ontario separated from everybody else? Well, the answer to that one goes way back when, many years, where those in the Ministry of Finance thought it best to have certain matters directly in the Act. Otherwise, people may not know that we have laws dealing with such matters. But that's from the policy side for those who are interested in why Ontario has it set out separately in their Act. Now, let's jump into the accredited investors. Who are these accredited investors? And let's start off with, why do we care? What's the size of this marketplace or use of this exemption at a very high level, Nadine?
At a high level, the accredited investor exemption is used by 90% of the overall investments in the private capital markets, and institutional investors is 97%. So the reason that this is so common is that it is outside of the prospectus offerings. When you get into the prospectus exempt world, which we like to call the private capital markets, because you use the word prospectus exempt, people think exempt, there's exempt from rules, but they're not. However, the accredited investor definition does allow for maximum flexibility for an issuer, because there's not as much regulation as there is in the prospectus world. So this is where it's the easiest from an issuer perspective. So it is very widely used. Within the accredited investor definition, there's actually 23 different types of definitions that an investor can fall within. And in this presentation, we're only going to talk about some of these definitions, and those are either the most commonly used or maybe slightly misunderstood definitions that we've come across.
Well put. Now, the elephant in the room, Nadine, is the elephant itself, which is the accredited investor exemption. If you're an issuer looking to raise capital, or an EMD or dealing representative and trying to figure out, why do I need to know this? Well, it completely dwarfs all other exemptions in terms of use by both individual and institutional investors, and in terms of dollars raised. Of the definition of who qualifies as a accredited investor, there are 23 types. Think of it as 23 buckets, and your investor has to fit into one of them. And we're going to look at some of them today and right now with Nadine. So with that, let's get right into the first one, which talks about the definition D of accredited investor. So if you look at a list of accredited investors, they have the various letters of the alphabet, which are linked to the definition. And we're going to start off with D, which is a person registered under the securities legislation of a jurisdiction of Canada as an advisor or dealer is an accredited investor. Nadine, give us more details.
So a person can include an individual, a corporation, a partnership, trust, etc. But generally, the registrant that is an advisor or dealer are corporations. And so this definition is looking at the entity or person that is registered directly as a dealer. This is separate and distinct from a person that is an associate or a representative of a registrant. So there is another letter that we'll get to next, but this is for the entity or individual that is registered directly as a dealer.
So very clearly, there's a definition of person. That's why it's underlined here, in that a person includes an individual, a corporation, a trust fund. So you really need to pay attention to your definitions within definitions. But I remember this one in an easy way, Nadine. D is for dealer and advisor. And that's how I remember quite easily that if I'm looking for what is the accredited investor for a dealer advisor, it's D. Now let's move on to E, which is an individual registered under the securities legislation of a jurisdiction of Canada as a representative of a person referred to in paragraph D, which we just said was a dealer advisor. Nadine, explain this type of accredited investor.
So this is where you, as a dealing rep, if you are purchasing directly, you are going to be an E. As a dealing representative, you represent a dealer, that is D. The most common mistake I do see is that when dealing reps want to purchase securities of an offering, they select D because they think of themselves as a dealer or an advisor, but you're registered as a dealing representative, and therefore you're going to select category E.
Now, I understand that some dealing representatives think that they are excellent. So the memory trick for this one is you tick E for excellent dealing representative for qualifying under the definition of an accredited investor. So that's how D and E work together. And again, want to point out the definition of individual. These are definitions within definitions, means a natural person, and then it excludes certain entities like partnerships, unincorporated associations, etc. So just think of an individual when referenced as natural person. Now we're going to deal with those types of individuals who are formally registered. And this is E1. An individual formally registered under the securities legislation of a jurisdiction of Canada other than an individual formerly registered solely as a representative of a limited market dealer or LMD under one or both of the Securities Act Ontario or the Securities Act Newfoundland and Labrador. Now, Nadine, explain E1 to us, because this is a relic from the past.
It is a relic from the past. However, it is also one that I do see used as well. So there are some people that used to be registered, and so they go under E.1. So from a dealing representative or dealer perspective, what I like to do is go to CSA, check before you invest. And if you go into the advanced options, you're able to look up former registrants. So you can type in the person's name and you can see how they were registered, because you can only select or use E.1 if they were formally registered as a dealing representative or an advising representative. And if it was a dealing representative, it could not have been of a limited market dealer. So limited market dealer comes from before 2009. It was a category before the exempt market dealer came out. They didn't have the same proficiency requirements, capital requirements, etc. So that is why it is specifically carved out from this definition.
I remember at the time, a lot of dealing reps of LMDs were wondering if they qualified, and this was explicit that they did not. And if you think about it, this does make sense from a policy perspective, because if you're formally registered, you've taken the exempt market product course. If you were a dealing representative for an EMD, you've taken these things. So you should continue being an accredited investor if you want to invest, if you've left the business or otherwise, and just have the status of an investor. So let's move on to our next category, which is pension funds. I, under the definition of accredited investor, which is a pension fund that is regulated by the Office of the Superintendent of Financial Institutions Canada, a pension commission or similar regulatory authority of a jurisdiction of Canada. That is a type of accredited investor. Nadine, expand on this and why you included this as something dealing representatives and EMDs need to know about.
We included this because in the private capital markets, you may be dealing with clients that are sole proprietors or they're professionals that run their own business, your accountants, lawyers, doctors, etc. And they might have set up holdcos to run their business. And then because they're not part of a larger company and they don't have group pensions or registered plans, they can actually set up an individual pension plan. And so these individual pension plans can be included as well.
Excellent. Thank you. Let's move on to another type of accredited investor, which is J. And we're talking about a very commonly used exemption is the financial asset test for a type of accredited investor. And it says under J, an individual who either alone or with a spouse beneficially owns financial assets having an aggregate realizable value that before taxes but net of any related liabilities exceeds $1 million. Now, Nadine, there's a lot of words packed into this definition. Rip them apart for us so we understand what is the financial asset test for an individual seeking to qualify under J of the definition accredited investor.
So the first part is to understand what is a financial asset. So financial asset does not include your residence or property or private businesses. You're looking at cash. You're looking at securities that are readily disposed of. So you're going to be looking at financial assets. The other is that you have to look at them minus any liabilities. So if there's margin accounts or borrowing that is used to make those investments, you have to make sure that it is net of that. So while it just says financial asset test, it is actually a net financial asset test. And so it does need to exceed the $1 million.
Very good point. So financial assets, we're going to get into net assets. We're going to get into net income. These are all key terms you absolutely need to understand. And to be crystal clear here, financial assets is specifically defined, and it means cash, securities, or contract of insurance, a deposit or an evidence of a deposit that is not a security for the purposes of securities legislation. Those are the three buckets. And cash is cash, and securities generally have to be liquid or relatively easy to liquidate. So if you have securities of a private company and just 4 people in it and they have a certain value, there's an argument that they are not generally liquid or relatively easy to liquidate. It's a private company. There's 2 or 3 investors. There's no market, things like that. So technically, you could not include them. If there's securities, for example, that you've acquired under the OM exemption and the issuer has a redemption policy subject to terms and conditions, there's a strong argument, depending on the facts, that those could be included within the definition of financial assets. And again, be very clear that you follow the definition and don't confuse the definitions, and that's why we're doing this. But financial assets has 3 buckets: cash, securities, and basically contracts of insurance. Now let's move on to our next one, which is J1, which looks a lot like J that we just read, Nadine, but a bit differently in terms of the financial thresholds. Let me just read it, and then I'll let you get into it. J1 says that an accredited investor is an individual who beneficially owns financial assets having an aggregate realizable value that before taxes, but net of any related liabilities, exceeds $5 million. Nadine, expand a bit on this exemption.
So same definition, higher threshold. So J.1 is for permitted clients. That's where we discussed previously, is that there's less regulatory protections in place for permitted clients. And so they're delineating between a accredited investor and a permitted client through J and J.1. So J.1 is that individual that meets that higher threshold of the net financial assets. So it's that same definition in terms of what can and cannot be included, but it's at 5 million. And because they're permitted clients, they don't have to sign the risk acknowledgement form.
Now, I must admit, when you look at J and J1, you're saying they look the same, other than one's 1 million and one's 5 million. So why did the securities regulators do it that way? And when you look at it on its face, it's confusing until you look at it differently, realize they created J1 because these are for permitted clients and put it at $5 million to identify them. And within the act, certain requirements do not apply to them. So that's why they had to create a separate category. So if you, like me, when you first looked at it, you're saying every individual would qualify for $1 million. Why do they also have one for $5 million? I get you. I was in the same position until I found out that there are specific requirements related to J1 that they carve out, including a risk acknowledgement form is not required to be completed by a permitted client because, again, it makes sense from a policy perspective. They are more sophisticated. Now, let's move on to K, which is the income test for individuals qualifying as an accredited investor. And it reads that an individual whose net income before taxes exceeded $200,000 in each of the 2 most recent calendar years, or whose net income before taxes combined with that of a spouse exceeded $300,000 in each of the 2 most recent calendar years, and who, in either case, reasonably expects to exceed that net income level in the current calendar year. Nadine, break this one down for us.
So the most common use of this is when you have a person that has an employer. And so you're looking at your gross salary. You want, as an individual by yourself, if your salary is over 200,000, or with your spouse over 300,000. So the idea here is you're looking net of your income before your income taxes, which is typically your gross salary. If you do have somebody that is close to that $200,000 or $300,000 threshold, you do need to make sure that they're not making registered plan contributions that does reduce their income, because that is a deduction to your overall income level. And if you are including income from other sources, for example, rental income, remember that has to be net of associated expenses. So if you have mortgages or borrowing that you use to get that rental income, that has to be netted off as well.
Yeah, there are key parts of this definition that I want to get into. The two most recent calendar years, there's a look back of 2 calendar years. That's important, that you've satisfied the $200,000 net income before taxes requirement. So for example, you may have satisfied that, but just lost your job. That's where reasonably expects to exceed that net income level in the current calendar year. You may not qualify anymore. So you really have to look at the different aspects of this definition to make sure that it works for you. Many people may look at gross, even though it says net income under the test. You have to subtract certain items. There's not explicit guidance in the companion policy to this, but if you look at 45106F9, which is the form for an individual accredited investor, they have to sign that as part of the exemption. There is reference in there that says you can find your net income before taxes on your personal income tax return, and reference is made to line 26,300 of the Canada income tax and benefit return that you may complete. So if you're borderline, you're going to have to be more careful on these things to make sure that the net income is satisfied. Okay, now we're moving into another type of individual accredited investor, which is based on a net asset test under L, which says an individual is an accredited investor if they alone or with a spouse have net assets of at least $5 million. Nadine, break that down for us, please.
So similar to the financial asset test, it's another bright line test. This time the criteria is net assets. So this means you can now include your residence, you can include the cottage, you can include the cars, you can include the art pieces, as long as the value on a net basis is over 5 million. Again, similar to financial assets where you have to make sure that it's net of any borrowing, the same for your net assets as well. So if you have a mortgage against the house, against the cottage, if you have a car loan, you need to deduct those from the overall dollar value so that you're looking at your net assets, ensuring they're over 5 million.
So Nadine, let's look at this a bit differently. Someone might say, I don't satisfy the net income test, and I don't satisfy the financial asset test. So how am I going to satisfy this net asset test? And you'd be surprised that what's happening now, there's a lot of wealth transfer as people are inheriting significant wealth. And you're going to find, in my opinion, increasing use of this because you have your own house and these other assets that you can now include. But it could be that you're going to have a net input of assets you didn't realize through an inheritance or otherwise. So this is one of these exemptions I think is going to be more commonly used and for registrants to pay attention to. Now we're moving on to a net asset test for persons, not individuals. And again, we go between individual and person. They're different. So this is M as a type of accredited investor, which is a person other than an individual or investment fund that has net assets of at least 5 million as shown on its most recently prepared financial statements. Nadine, break this down for us.
So this is a question that I've received before in the past as well, because you see the word person, and so then you think an individual is included in here. But as the carve-out says, that you have to exclude individuals or natural persons. So you are looking at entities, so corporations, etc. So you're looking at a person, an entity that has more than 5 million of net assets. Again, you have to make sure that it's net of any expenses, borrowing, etc., and that the overall dollar value is over 5 million.
Excellent. All right, now we're getting into another type of accredited investor, which is those involving managed accounts. This is Q under the definition of an accredited investor. And it reads that a person acting on behalf of a fully managed account managed by that person, if that person is registered or authorized to carry on business as an advisor or the equivalent under the securities legislation of a jurisdiction of Canada or a foreign jurisdiction. Nadine, break this down for us.
So this is where an account is managed by a portfolio manager. So you have an advising representative that is making the decisions for the benefit of the account. So they have the discretionary authority for those decisions. So in this instance, the regulators are looking to see that it's the advising representative that is making the decisions on behalf of the client, as opposed to the client making the decisions themselves. So in these managed accounts, it is the portfolio manager that is the accredited accredited investor. This is also important from an issuer perspective because there are different jurisdictions that have different reporting requirements. So if you have a portfolio manager, for example, in Ontario, and they're managing an account for a client in Quebec, there's additional reporting and fees required. There is CSA Staff Notice 45325, filing requirements and fees payable for exempt distributions involving fully managed accounts. I suggest that you read that and you read it very carefully as an issuer. This covers Quebec, Manitoba, and Saskatchewan. They have different fees and filings and notices. They're not all the same. So for example, in Quebec, like I said, if you have a portfolio manager in Ontario, but the beneficial account holder is in Quebec, you have to file the distribution under your 45106F1 under Ontario. But then in addition to that, you have to provide a letter to the Quebec securities regulators saying the dollar value of the amount of managed accounts that is associated with a Quebec investor and pay fees on top of that.
Thanks, Nadine. I remember when this came in Ontario, people were really happy that this could now qualify as a accredited investor managed account. And I think that makes sense from a policy perspective because you have the requisite safeguards of having a registrant fully manage your account, even though you're not technically an accredited investor. So I remember when that came in, there was a lot of excitement in terms of opening the door for more types of accredited investors to participate under the accredited investor exemption.
It was a big complaint because the managed account was being managed by a portfolio manager who in and of themselves is considered an accredited investor, but their accounts that they were managing for their clients did not qualify. So this was a big win from the portfolio manager's perspective. And I think ultimately it's a win for the investor and also a win for issuers that are now able to accept those investors' assets.
Absolutely. Now let's move on to T, another type of accredited investor. Some people call this the syndication definition of an accredited investor or syndicate. And T says a person in respect of which all the owners of interests, direct, indirect, or beneficial, except the voting securities required by law to be owned by directors, are persons that are accredited investors themselves. Nadine, break down this one.
I consider this a look-through test. So this is where if you have a company where the company doesn't have sufficient assets to be considered an accredited investor, but the owners are accredited investors, it's an ability for you to look through to those owners and ensure if they are accredited, then the entity can make the purchase itself. You tend to have personal holdcos or small companies that are owned by investors that are using these for tax planning purposes, etc. But the companies itself doesn't meet the financial. But this is a way for that entity to make that investment and for them to continue with their tax planning.
So this is a really interesting and helpful definition for accredited investor, but I imagine as a CCO, Nadine, this can be a little bit unwieldy at times. I'm thinking of an example where if it's just one or two investors, I see that's manageable, but if you have like 8 or 10 investors, individuals, and then you have 2 of them that are companies, and then you have to break those down to go to the upstream beneficial holders, that's kind of a lot of work for everybody, including the dealing representative and the EMD to gather all that information. What's your experience in doing that type of due diligence and the time, money, and effort involved in those types of trades?
Generally, people will make investments directly themselves as well as through their holdcos. So you already have that relationship with the investor. And then also you have to do that look through from an AML perspective anyways. When you have an entity buy, you have to look through to the beneficial ownership. So now you're just adding the additional layer of ensuring that those beneficial owners are accredited investors as well.
Got it. Makes sense. All right, now we're looking at W, which deals with trusts in terms of the definition of accredited investor, which is a trust established by an accredited investor for the benefit of the accredited investor's family members, of which a majority of the trustees are accredited investors, and all of the beneficiaries are the accredited investor's spouse, a former spouse of the accredited investor, or a parent, grandparent, brother, sister, child, grandchild of that accredited investor's investor's spouse, or of that accredited investor's former spouse. Lots packed into that one. Break that one down for us, Nadine, because I know a lot of dealing reps deal with trusts, and they're trying to figure out what do they need to know about ensuring compliance with this trust definition of an accredited investor.
So this is where you have your accredited investor who establishes a trust for their family. Similar to AML, you still have to identify who all the beneficial owners are. Now you have that added a requirement to look at the trustees. Generally, there aren't that many trustees, so that's not too onerous. And sometimes they're accredited investor themselves. Where the extra layer comes in is that you're actually looking at those definitions to ensure that the beneficiaries meet those specific definitions as outlined in the definition. That it is the spouse, the former spouse, the parent, the grandparent. Just because they're listing family members and you feel like they mean to include everybody. No, they're very specific. They're outlining the category, the requirements. You cannot include nieces and nephews, etc. You can only include those that are specifically listed in this definition.
Oh, that's a good point. That's why they're called prescribed. They have to be one of these types of relationships directly with the accredited, or it doesn't work. So you'll also look at this as a trust, a family trust that's set up. And typically there would be some sort of declaration of trust or a trust agreement that would be set up where it would identify who the trustees are, who the beneficiaries, what property was put in the trust. I would start there in terms of doing your due diligence on this type of accredited investor to see if you qualify. Now, we're going to switch to permitted clients. We're done with the accredited investors, but a special type of accredited investor is a permitted client. So give us some opening comments on this as opposed to the accredited investor definition, because this one too has many buckets or categories that we have to separately review, and many of the definitions kind of roll over from the accredited investor definition.
Thanks, Brian. There are a lot of definitions here still. There are 18 as opposed to 23 with accredited investor definitions. And the permitted client definition is not found in 45106. Instead, it's found in National Instrument 33103. So you're looking at a smaller list of definitions and with higher bright line tests. So there is some overlap, but there's definitely differences as well.
Okay, so we'll go over these ones, and you'll find that some of them sound like we just went over them for the accredited investor definitions, but we should go over them so everyone clearly understands these types of categories of permitted client, because certain regulatory requirements are not necessary for permitted clients. So let's start off with the first type. For person or company, this is D under the definition of permitted client, is a person or company registered under the securities legislation of a jurisdiction of Canada as an advisor or dealer, other than a scholarship plan dealer or a restricted dealer. Break this down for us, Nadine.
So this is very much similar to accredited investor in that this is the entity or individual that is registered as an advisor or a dealer. So this is not the dealing representative, this is the dealership itself. And so some might think with under accredited, the dealership and then the dealing representative are both accredited investors, but a dealing representative is not a permitted client.
Okay, so we said D under the definition of accredited investor is for dealer and advisor. And I see, guess what? It's under D for the definition of permitted clients. So we now know that a dealer or advisor is not only a accredited investor, but a permitted client. Let's move on to our next category for individuals. O, which is a permitted client, is an individual who beneficially owns financial assets as defined in Section 1 of 45106. We went over that earlier. Having an aggregate realizable value that before taxes, but net of any related liabilities, exceeds $5 million. Nadine, break this definition down for us.
So we did touch on this briefly when we were talking about accredited investors, and we talked about J.1. So it is the net financial asset test again. So the cash, securities, certificate of deposits, etc., that can be counted. It has to be net of any borrowing, and it has to be over 5 million. The other piece that differentiates this is that with the financial asset test for accredited investors, you can also include the financial assets that belong to your spouse. So it is only that individual's financial assets that can be used in calculating that $5 million.
Just think of it as higher qualification requirements, less protection. So there's a correlation because you're deemed to be more sophisticated or able to fend for yourself, as they say. All right, now we're going to look at trusts. We talked about trusts a moment ago under accredited investors, and this is P under the definition of permitted client, which is a person or company that is entirely owned by an individual or individuals, referred to in paragraph O, which we just read, who holds the beneficial ownership interest in the person or company directly or through a trust, the trustee of which is a trust company or trust corporation registered or authorized to carry on business under the Trust and Loan Companies Act Canada or under comparable legislation in a jurisdiction of Canada or a foreign jurisdiction. Nadine, please get into this one so we can understand it a bit better.
So this for me is another look through, right? So you're looking through to the entity and looking through who the trustees are, looking through the beneficial owners and making sure that they're meeting that definition of a permitted client.
Right, now we're moving into Q, which is the 25 million net asset test, and it defines a permitted client under Q as a person or company other than an individual or investment fund that has net assets of at least $25 million as shown on its most recently prepared financial statements. A lot of definitions in this one. Nadine, please expand on this type of permitted client.
So this one again is referring to persons or entities. They're specifically excluding natural persons. You cannot include an individual or an investment fund. There's actually a separate letter for investment funds, and you want to ensure that the net assets, which again can include securities and assets beyond just financial assets, so it can include property, it include cars, it can include whatever assets are held by that company, but it has to be net of any expenses, net of any borrowing, so that it is the net assets are $25 million.
And again, where would you find that information? Very key to this definition is the most recently prepared financial statements of that person or company. That's very much embedded in this definition. All right, now we move on to another type of permitted client under R, which is a person or company that distributes securities of its own issue in Canada only to persons or companies referred to in paragraphs A to Q of the definition of permitted client. This is kind of a basket clause, if you will. Can you expand on this definition, Nadine?
So that's another look through. So these are for these entities that are owned by permitted individuals. So the company itself might not have 25 million in net assets. Let's just say it has 20 or 15 or 10, but the people that own it are permitted clients. So when you look through to the permitted client, as long as the people that own the company are permitted clients, then you can rely on R without that entity itself having to have 25 million in net assets.
Great. Now we're switching over to the third and final part of our discussion. What is an eligible investor, as well as a non-eligible investor by definition? And let's start off with some general high-level comments about this eligible investor term, Nadine.
So a lot of times I'll get the question of, is my client eligible? And so, then having to ask, well, what are the different prospectus exemptions that this offering is available under? If it's under 2.3, available to accredited investors, it's about whether or not that person is an accredited investor. The eligible investor definition is only under the offering memorandum exemption. And so some people will think if that their client meets the eligible investor test, that they can also buy under the 2.3, the accredited investor test, but that's not the case. The offering has to meet the prescribed criteria, the form requirements, as well as the investor protection levels of the offering memorandum exemption. Of the exemptions, the offering memorandum exemption is probably the most complicated. If you have problems reading at night, I suggest you open up 45106 section 2.9 and read that long piece of legislation. The offering memorandum exemption has different ways that it is offered throughout the jurisdictions. I think there's about 4 different buckets that the offering memorandum exemption can be used. And depending on the jurisdiction of the investor is what criteria has to be followed. So while this is the 45106 is a national instrument, the different provinces and jurisdictions decided to have different ways of making this offering memorandum exemption available to investors. So you have one end of the category, for example, BC, which has the least amount of requirements under the OM exemption, to some of the more stringent, such as Ontario. And there's a lot of different requirements depending on where those investors are located. So it is not a common exemption that's used. As we talked before, the accredited investor exemption is much more common, and that is because of the simplicity of it. The offering memorandum exemption is more complicated. It does provide more investor protections, but it is not as stringent as a prospectus offering. It's kind of this middle ground that makes private capital market investment opportunities more available to a broader public with more protections.
All good points. One way to look at the two exemptions, the accredited investor exemption is basically a uniform exemption across Canada under Section 2.3 of 45106. However, the offering memorandum exemption is not uniform. There's different flavors or types, and different jurisdictions have subscribed for the different types of offering memorandum exemption. And not only is there a lot written in the instrument, 45106, but also the companion policy has a lot of information. But getting back to the main point here is a lot of times someone will use language like, well, are they eligible? Do they qualify? And this is how we normally talk about investments. And this has to do with a prospectus exemption. So you can say, hey, is someone eligible to invest as an accredited investor? That's the common parlance use of that term. And what we're getting into is there is a specific definition of, are they an eligible investor, sometimes called, are they an eligible or non-eligible investor? And that is specifically linked to the offering memorandum exemption. So we just wanted to be clear on the distinction of the use in common practice versus under this specific exemption. Now let's start off with the first part of the definition of an eligible investor. There's many different types of eligible investors. We're only going to focus on a few of them. This has to do with an individual, and this is under A, Roman numeral 1. It's a person whose net assets, alone or with a spouse, in the case of an individual, exceed $400,000. And I know, Nadine, when we talked about an eligible investor, I liken it to a baby accredited investor. I think you have your own term for it. So why don't you kind of get into that definition and how you look at this relative to an accredited investor definition?
I use the term accredited investor light because the bright line tests are lighter. So for that person, asset test is not a financial asset test. They only have the net asset test. So you can include your principal, but again, it has to be net of any borrowing. And you're looking at only 400,000 as opposed to the 5 million. Right? Or even the 1 million financial asset test. So it's a lower threshold, easier to obtain.
Now, I do note here that you can include one's house minus any mortgage in the net asset test, and that's very important in terms of qualification. Any other definitional items that we should be aware of under the net asset test?
So you can include your other assets as well. So it is similar to the net asset test for accredited investors, just it's a lower threshold.
Got it. All right, moving on to another type of net income test, individual eligible investor. It's a Roman numeral 2. And this type of eligible investor is a person whose net income before taxes exceeded $75,000 in each of the 2 most recent calendar years, and who reasonably expects to exceed that income level in the current calendar year. Break this one down for us.
So similar to the accredited investor, is you're looking at your net income, or if you're employed, your gross, but it's a lower threshold. Instead of being 200,000, it's 75,000. You also need, if you are closer to that threshold, remember to look to see if there's registered plan purchases that are made that bring that salary level or that income level down. And if you have other income, such as rental income, making sure that you're offsetting that against any expenses, so borrowing, mortgages that go against that, the asset that is used to generate that rental income.
Okay, now let's move on to another type of eligible investor. This is a Roman numeral sub 3 in the definition of eligible investor under the offering memorandum exemption. And that is a person whose net income before taxes, alone or with a spouse, in the case of an individual, exceeded $125,000 in each of the 2 most recent calendar years, and who reasonably expects to exceed that income level in the current calendar year. Nadine, let's get into this one.
So again, the accredited investor has the same definition where you can include your net income with your spouse. However, instead of being 300,000, it's 125,000. And as per Brian's previous notes, remember you're looking back at the last 2 years and then also making sure that it's reasonable going forward. So if you've recently lost your job or you're changing careers and you might not be at that same salary level, you might not be eligible as an eligible investor.
Correct. Now let's look at another type of eligible investor where the majority of these eligible investors within being owners or directors. And this is B of the definition of eligible investor, which states that a person of which a majority of the voting securities are beneficially owned by eligible investors, or a majority of the directors are eligible investors. So break this down for us, because there's 2 parts to this definition in terms of beneficial ownership and then who's on the board.
So with the accredited investor, there was an asset test for the entity. And then there was a look through if that entity didn't meet that threshold. Under the eligible investor, there is no net asset threshold. They're literally just looking at who owns it or who are the directors. And so with the directors, you need to then look to see, are the directors, the majority of them, are they eligible investors? And the other test is to look at those that own the majority of the voting securities. And so then you're looking to see that those beneficial owners, as you're going to look through till you get to the naturalized person, and make sure that they meet the eligible investor test.
Now, Nadine, I'm hearing a lot of words like beneficial ownership. Let's go down that rabbit hole, because a lot of registrants would say, what do you mean by beneficial ownership? What does that mean when you beneficially own securities?
So the beneficial ownership, there's about 4 key factors that you want to look at. Number 1, do you have the ability to physically possess or own those shares or those assets? And do you have control over them? Number 2, you're going to look at entitlement to income. So if that asset pays dividends or interest, do you, as a beneficial owner, receive or have the entitlement to receive that income? As a beneficial owner, you would have risk of loss. So if that entity loses money, you lose money. I like to call that skin in the game. The other piece is the ability to dispose of the shares. So if you're able to dispose or sell that asset, then you have beneficial ownership. Unless you have ownership, you can't sell it. So another thing, if you have an RSP that you directed, that can be included in that asset calc. However, if you're in a group RSP, that means that there's somebody else that's controlling it and making the investment decisions. Therefore, you do not beneficially own those assets.
Well done. We needed to go down this rabbit hole to understand the concept of beneficial ownership, because it comes up so frequently in the definition of accredited investor and eligible investor. But let's go back to our definitions of eligible investor, and let's look at what I call the entity types of eligible investors. And these are C, a general partnership of which all of the partners are eligible investors. D, a limited partnership of which the majority of the general partners are eligible investors. And E, a trust or estate in which all of the beneficiaries or a majority of the trustees or executors are eligible investors. Break this down for us, Nadine.
So here we have another look through. So you're looking through to see who is the owner, who's the controller, who has the voting decision, etc., of these entities, and making sure that they're eligible investors. So this goes along with B2, the other definition that we just spoke about with persons or companies. And when you're dealing with people that are creating holdcos that are dealing with trusts or creating partnerships to make investments, this is for you an opportunity to work with your client or your investor to help them to be able to invest in the private capital markets. You're going to be looking through to these investors or to these directors or trustees from an AML perspective anyways. So it's just an additional layer of checking to see that they meet the definition of an eligible investor as well.
Okay. Now we're looking at an eligible investor as also including under F, an accredited investor. Now let's pause for a second. We know there's an accredited investor under the Accredited Investor Exemption, and now we're told that under the list of the different types of eligible investors, there's a box under F for an accredited. How does that work?
So if you were an accredited investor, you would obviously also meet the definition of an eligible investor. So then you might ask yourself, well, why am I going to use the eligible investor if my client or if I as an investor meet the accredited investor definition? And that's for the additional protections and additional information that the issuers have to convey to you. So under the OM exemption, it's a higher level of investor protection because the regulators deem that under the OM exemption is generally meant for people that have a lower ability to risk the loss of potential assets or do not have the same level of access to advice as accredited investors. So they build in additional protections, additional disclosure requirements, both initial upfront in the offering document as well as ongoing into the OM exemption. So even if your client or you as an investor meet the accredited investor definition, you might want to look at putting in your purchase through the OM exemption as well as an eligible investor. But you do have to be mindful of limits. So when you do purchase under the OM exemption, there is a requirement that you can, if you're working with a dealing representative, you can put in only $100,000 over a 12-month period. If you are an accredited investor and you do have the room to be able to invest under the OM exemption, it does offer you additional protections, and you might want to consider if you have filled up or you want to exceed that maximum allowable amount to purchase under the eligible investor definition under the OM exemption, you might want to break it up into two orders and do one under accredited and then what you can under the OM exemption, just to give yourself that greater level of investor protection, as well as in the different jurisdictions, additional information rights as well.
Well put. Bottom line is, if you're an accredited, you want the benefits of the disclosure and other investor protection built in the offering memorandum regime for all eligibles. Why not? But if you purchase it outside of the offering memorandum exemption under the accredited investor exemption, you may not have all those benefits. You might, but that's where the two exemptions work together and why you would elect one as opposed to the other. As you said, this is a whole nother topic that we can go down and try to understand this better and the pros and cons, et cetera. But the bottom line is, if you're an accredited investor, you could be an eligible investor. And now we're working into a related concept for G, is that an eligible investor also includes a person described in section 2.5 of 45106 involving family, friends, and business associates. Just expand on this one a bit further, Nadine, for us.
So there is another prospectus exemption, 2.5, the family, friends, and business associates exemption under National Instrument 45106. You can, if you meet that definition, similar to an accredited investor, can also use eligible investor and purchase under the OM exemption. The same thing with this friends, family, and business associates. The thing to remember is that you need to make sure that you're following the requirements of meeting that definition of a family, friend, and business associate. Similar to when we're talking about some of the other definitions, they're prescribed definitions. So the family members can only be those family members that are listed in 45106 under 2.5. For friends, you need to make sure that they're not just casual friends that you have on Facebook or LinkedIn, or you met at a conference or at a family barbecue once. But these friends need to be somebody that if the regulator were to come in and look, they would say, yes, I agree that you're actually friends with the main people that own this business. So you need to make sure that you're taking the time to ensure that the investor meets that definition of the friend, family, or business associated when looked at by a regulator, and that they're not just relying on that. But again, why would you want to do this? Similar to if you're an accredited investor, it's the opportunity to get those additional protections in terms of disclosure, depending on the jurisdiction in which the investor is located.
All right, now we're kind of bringing this all together. We went through this long list of eligible investors, not all of them. And now we're getting to this concept, well, who's not an eligible investor, or often called a non-eligible investor? Nadine, let's get into this one so we can put this all together now.
So there is no definition of non-eligible investor. And if you are a non-eligible investor, you're still eligible to invest under the OM exemption.
So there's not a definition in the instrument that says non-eligible investor means someone who's not an eligible investor. So it doesn't explicitly say that, but by inference, you have to understand it, right?
Absolutely.
Okay.
It is the opposite. So if we talked about eligible investors and that they can invest a maximum of 30,000 without a dealing rep, 100,000 with a dealing rep. If you're a non-eligible investor, you can do 10,000. It's still that same rolling period of 12 months. So as an issuer, you do need to make sure that you're collecting enough information that you can ensure that that investor is not exceeding that $10,000 limit.
Excellent. Good to know. All right. I think we're wrapping up now, and we have certain key takeaways. And so, Nadine, let's jump into these 3 high-level takeaways from our discussion today on explaining different types of investors, being accredited investors, permitted clients, and eligible investors.
So these are 3 different and distinct definitions located in different places. It is important for both the dealing representative, the dealer, as well as the issuers to know. From an issuer perspective, while you do not have to do that due diligence to ensure that the investors are meeting the different definitions, and that is the responsibility of the dealing representative, you do need to make sure you understand those different definitions at a high level. So when you're doing your 45106F1 filing, you're not going to be questioned by the regulator of why you're using J, K, or L for individuals, but it's being purchased by an entity or a corporation or a trust. So, you need to make sure that you understand the different levels, the letters, the different implications, particularly with managed accounts and the different additional fees and reporting that you might have to do. And then for your dealing representatives, it's important for you to know your client, to ensure that what you know about your client is consistent with the definition that is being selected for the particular investment. Just having a client sign off that they meet a definition is not sufficient. You need to look at the KYC forms, look at the information you've collected on the client, make sure it makes sense with the definition that is being used. And so part of that is ensuring you have good books and records, because when the regulators come in, they're going to ask to look at your files before they look to talk to you. So you need to make sure that the information used is available in your files. If it's not on your form, you might want to jot down those assets and income and borrowing information yourself so that you can show that you've done the analysis yourself to say, yes, the client meets the financial asset test or the net asset test or the income test, to show that you have in your files that you protect yourself. So when the regulators look, they can go, yes, this dealing representative knows their client and knows that they meet this definition. And also, when in doubt, ask questions, because if you are going to ask questions, or if you're a dealing representative, if your compliance department asks you questions, then you know that a regulator would ask those questions too. So make sure if you have any questions, you go back, talk to your client, ask the questions to get the information until you know that you're satisfied.
Well, that's a job well done. Appreciate your analysis and insight, Nadine. For those watching or listening to this, we want to be very clear. This is just dealing with qualifying under prospectus exemptions, which is part of your Know Your Client analysis, and has nothing to do with suitability, which is a whole nother rabbit hole you have to go down. But I know that both of us have had many questions over the years from different registrants, dealing representatives, people in the community here saying, can you kind of go over the difference between an accredited investor, a permitted client, and an eligible investor, and how do they all fit together? So hopefully people have benefited from this. And if you have any further questions or otherwise, let us know, or other topics for discussions. We'll happily dive into them and have this type of format. If you have any comments, suggestions, or recommendations, please make them, because we're listening and we're here to educate and train you to help you grow your business in a legally compliant manner. Any final words, Nadine?
Brian, I just wanted to also thank you for your time and effort, and for asking those insightful questions, and for adding on to make this a wholesome discussion. And I wholeheartedly agree with Brian. We're here to help and support you. We don't replace legal advice. However, we can provide our experiences and try and help you with the questions that you have. Anything else, please feel free. Let us know. Reach out to us at PCMAcanada.com, send an email, reach out to us through LinkedIn. We're happy to help you out.
Thank you.